If we do break through 50 today or tomorrow or this week or anytime soon, it'll be the first time we break back through 50 without an immediate crash in the silver price. It looks like we are going to accomplish this any day now. And when we do, we can probably confirm 50 as a new baseline for silver trading. And yes, once we get the final crunch in the dollar and the final printing round after that, then we will skyrocket to who knows what, who knows where. The numbers really don't matter that much. All that matters is that you recognize what money is and what credit is and the difference. Deathbed. Getting to the price action. This is the simplest explanation as to why this is not a 2011 market. You can see here in 2011, we hit 49.50 over here. It was at 49.60 about. And within 5 days, look at these candles. 1, 2, 3, 4, 5. 5 business days, 5 trading days, we hit $33. That is a huge fall. We're not seeing anything like that this time. We saw the same thing in 1980 where we hit 50 briefly on January 21st. Within a week, we were down to, I think, in the 30s again, something like that. It was brutal. This time is not even close to that. But let's get into something a little bit more in depth here. You can see this is an article from May 10th, 2011, about 9 days after the run to 50 or the run to 49.50 in 2011. You can see here back to this chart. This is April 30th, I think, when we hit the closing high, or April 29th, one of those days. Very late April. This is May 10th, about 2 weeks later. Silver margin changes by CME since 2009. CME Group raised margin requirements for the 5,000-ounce silver futures contract 5 times over a 2-week period by a total of about 84%. The margin hikes, cited as one of the triggers for the broad-based rout in the commodities complex last week, sparked a slide in silver prices since touching the record high of 49.51 an ounce on April 28th. CME, the world's largest commodities exchange, hiked margins to $14,000 per contract from $12,000 effective May 5th and again to $16,000 effective May 9th. Prior to April 25th, the margin stood at $8,700 per contract. So they hiked margin to $16,000 by May 9th from $8,700 while silver was reaching its all-time highs. Now, what is margin? It's simply the amount of money that a trader has to put down in his account as cash before he takes a position in a silver futures contract. The CME requires these margins in order to ensure against default and other risks. And so the more cash a trader has to put down to get these contract positions to go long, the less he's going to put, the less he can put down, the less fewer contracts he can afford to buy because he needs more cash in order to buy them. So the higher margin goes, the demand for silver futures contracts goes down and price goes down with it. That's what tends to happen, especially in a weak market where silver wasn't fundamentally at $50 that yet, but there was a speculative frenzy that brought it up to there. Now, where are we now? Remember, the CME hiked margin to $16,000 per contract in order to get silver prices down, and they succeeded in doing that very well. Where are we now? What's the margin requirements? Well, I'll give you this PDF directly from the CME. You can see here this business date, September 26th, we are at $16,000 margin, the same margin that was required after the crash of the silver futures market in 2011. It was hiked up to 16,000. You can see that they hiked it up from 15,000 a few weeks before. This is September 17th, September 15th. If you keep going, back in 2024, you can see here, this is July 19th, 2024. Margin requirements were $11,500. Basically, what I'm saying is that margin requirements are the same as they were in 2011 at these prices in the upper 40s, but this time it's not pushing futures down. In fact, we're having a big bounce today, which means that the fundamentals of the silver market are a lot better now than they were in 2011. But let's go to the next slide. These are the silver supplies in Shanghai to support their futures trading market for silver. You can see here we are at an all-time low of 623 tons. This is down from a high of over 3,000 tons in early 2021. We are about 20% of that now, so 80% of the silver in Shanghai has been sucked out since 2021. So London is not the only trading futures trading hub that is short supplies. Silver has been flowing from New York to London, and it's probably going to have to flow from New York to Shanghai, or maybe from Switzerland to Shanghai through New York through some mechanism. But yes, China is very low on physical silver now to support their futures trading over there. This is a worldwide phenomenon. This is an important technical pattern here. This is the silver to S&P 500 index ratio. So you see here that since 2011, last time we hit $50, that was a high for the silver to S&P 500, meaning the S&P was very cheap relative to silver. Silver was at a high relative to the S&P, and since then, silver has been falling. It looks like, first of all, we hit a double bottom hit in 2022. You could arguably call this a triple bottom if you want to count this as two tags and it looks like July and October or something like that. But anyway, it looks like we have a firm double, maybe triple bottom over here, and we haven't gotten close to it since. But we still have to break through this trend line here on the top, and that connects the 2016 top with the 2020 top and the recent top that we just saw a few weeks ago when silver hit 54. Once this breaks, I think we can kiss this bear market that's been in place since 2011 versus stocks goodbye. It arguably ended over here in early 2024, and we are on our way up now, but we do have to break this trend line. And in another perspective, it's possible that we already have. You'll see that over here. This is the same chart, except it's flipped. This is the S&P 500 to silver ratio. This is silver to S&P. This is S&P to silver. So basically, same ratio, just flipped. You can see here that in this angle, it looks like we already broke through, right? If we broke through it to the downside, that means that silver is becoming more expensive relative to stocks. And this is the ratio that is really going to get the public attached and realizing that silver is moving higher because credit is moving lower. Because if they realize that their stock portfolios are not really helping them and that all the purchasing power is going into money anyway and stocks are not fighting their purchasing power loss as much as they thought they were, then you're going to see a whole bunch of stock portfolios plow into real money, and that will be an end game signal as well. So we see here that we broke through this trend line. We're going to break back through it again. It says here that we are at 139. That is still below, that's just above the trend line now. So we broke through it briefly, broke back above it, and it looks like we're going to break back below it today with silver up about 3% on the futures market. Once this trend line breaks, we're going to head towards the 2011 lows, and the 1980 lows are even below that, but we'll see that over here. This is the same ratio, but stretched out to 1970. I put two squares here, or two rectangles in blue. You can see here's the same trend line from before, except zoomed out. You can see we broke it over here, and this says we're at 139, and the trend line looks to have broken through at about 144, 145 something. These are not exact. There's slight differences in the way these are calculated, and I don't know the exact differences, but they're close enough. But the reason that I put two rectangles here, one here and one here, is that this pattern over here, looks like a repeat of the pattern over here from 1970 to 1980. This is more drawn out and more extreme, but you can see here's a peak. The corresponding peak over here is in 1972, 1973, something like that. And then we fell down, meaning silver became way more expensive relative to the S&P by 1974 and 1975. And then we have a little bit of a rounded peak over here, which would correspond to this over here in the mid 70s. And then we went down to the 1980 peak, where silver was the highest value relative to stocks, and stocks did nothing compared to silver. It looks like if we break this trend line down here, we could head into the equivalent of 1980. This is it's a rhyming pattern here. I don't know if it's the exact same thing. It's never the exact same thing, but it's pretty close. And yes, we are going to get to 1980 numbers, and once we do, there will be panic and blood in the streets, or silver in the streets. I think, wait, what, doesn't the unicorn have silver blood or something? So it'll be a unicorn, right? If we do break through 50 today or tomorrow or this week or anytime soon, it'll be the first time we break back through 50 without an immediate crash in the silver price. It looks like we are going to accomplish this any day now. And when we do, we can probably confirm 50 as a new baseline for silver trading. And yes, once we get the final crunch in the dollar and the final printing round after that, then we will skyrocket to who knows what, who knows where. The numbers really don't matter that much. All that matters is that you recognize what money is and what credit is and the difference